What is going on, everybody? Good morning, good afternoon, or good evening, depending upon what time of the day you're listening. I'm your host, Dylan, here with another episode of the Tip Share, where we dive deep into the labyrinth of all things restaurant. Get up and get excited because it's time to share our tips, people. Today, we're going to be diving into how to create a balance sheet for a small business. Now, you might be asking yourself, what is included in a balance sheet? And we're going to be looking at how to create a balance sheet and how that begins with documenting and understanding its key components. This starts with assets, which are your current assets, all your cash, accounts receivable, marketable securities, prepaid expenses, inventory, and long-term assets, such as any fixed assets, intangible assets, or long-term securities. The next one that we're going to look at is liabilities. So this includes current liabilities, utilities, taxes, accounts payable, short-term debt, and long-term liabilities such as bonds payable or long-term debts. The last thing here is shareholders' equity. So that is share capital as well as your retained earnings. This is all of the stuff that's included in a balance sheet. Now, we're going to look at the internal and external importance of a balance sheet specifically. So internally, your balance sheet is a tool for assessing your small business liquidity, identifying financial trends and issues, and prompting necessary operational adjustments. And as far as externally goes, a well-documented balance sheet assists investors, lenders, and stakeholders in your financial position, as well as being able to determine available resources and financing methods for you and ensure compliance with reporting laws for external auditors. Now we're going to be looking at a step-by-step guide to creating a balance sheet. So the process of how to create a balance sheet involves several key steps. Today we're going to be going over 8 steps. And the first one being that selecting the balance sheet date commonly set on a quarterly or monthly basis, which signifies the period you're examining. Number 2, you need to list all of your assets, arranging them by liquidity from cash and accounts receivable to longer-term investments. Number 3, after listing your assets, verify the total assets against your general ledger, which acts as a master list of all financial transactions, and to ensure accuracy as well. Number 4, determine your current liabilities at this point, which includes the money you owe soon, such as accounts payable or AP, short-term notes payable, and accrued liabilities. Number 5, calculate your long-term liabilities that extend beyond 1 year, such as long-term notes, bonds payable, pension plans, and mortgages. Number 6, follow your liabilities assessment and add all of your current and long-term liabilities to provide a complete financial picture. Number 7, then you're going to calculate your owner's equity, factoring in retained earnings and working capital, essentially showing the value left for owners after all of your debts are paid up. And finally, number 8, validate your balance sheet by ensuring the total liabilities and owner's equity matches your total assets. Thank you guys so much for tuning into today's Tip Share episode. That is all for today. I'm your host, Dylan. Feel free to go listen to any of our other episodes. We have a lot of amazing content for you on how to navigate the restaurant industry. But until then, we hope you have a great week, have a great day, and we'll see you next time.